It began like any other trading day. The opening bell rang, orders flowed, and the vast, intricate machinery of the global financial system hummed along. But then, a flicker, a barely perceptible tremor in the data stream, a signal that, in retrospect, was the first sign of the storm about to break. Within hours, the hum would become a roar, and the flicker would become a firestorm. A $600 billion blackout wiped out wealth overnight. This wasn't a gradual correction or a predictable downturn. This was a digital avalanche, a sudden and catastrophic failure of confidence that cascaded through the system with terrifying speed. Stocks plunged. But to say they plunged is an understatement. They fell off a cliff. The problem wasn't just that everyone wanted to sell, it was that suddenly, there was almost no one left to buy. The bid side of the market evaporated. Panic sold into thin liquidity. Imagine a crowded theater where someone yells, "Fire!" Everyone rushes for the same few exits. That's what happened here. The exits were the buy orders, and they were vanishing. Sellers, desperate to get out at any price, began a frantic race to the bottom, each sale pushing the market lower and triggering even more fear. Dominoes fell. The first to go were the highly leveraged traders, their positions automatically liquidated by margin calls. Then came the algorithmic funds, their pre-programmed instructions turning them from buyers to relentless sellers in a microsecond. Each fallen domino didn't just knock over the next, it sent shockwaves that destabilized the entire structure. Banks shook. Institutions that seemed like pillars of stability just hours before were now facing staggering, unrealized losses on their books. Their own trading desks, their investment portfolios, their loan collateral, everything was suddenly repriced downwards in a single brutal stroke. The question on every CEO's mind was no longer about profit, but survival. Funds shook. Hedge funds, mutual funds, pension funds, the supposed smart money, were caught in the same vortex. Complex hedging strategies failed, diversification models broke down, and correlations all went to one. The very instruments designed to protect them, like ETFs, became vectors of contagion, forced to sell their underlying assets to track the collapsing indexes, creating a vicious feedback loop. Retirement accounts shook. This wasn't just a story for Wall Street. For millions of ordinary people, years of diligent saving, of contributing to their 401ks and IRAs, saw a decade of gains erased in a day. The number on the screen, the one they were counting on for their future, for their security, was decimated. The abstract chaos of the market had found its way into their homes. Headlines screamed, "Market in free fall," "Black Thursday," "Trillions lost." The media, struggling to keep up, plastered every screen with a narrative of fear and uncertainty. But behind the sensationalism was a genuine, terrifying question. Had the system finally broken? Regulators scrambled. At the Federal Reserve, the Treasury, and the SEC, emergency meetings were convened. Phones rang off the hook. They were the system's ultimate backstop, but their tools were designed for slower-moving crises. They could inject liquidity, issue statements, and halt trading. But could they restore confidence? That was the billion-dollar and now $600 billion question. So how does this happen? How does a modern regulated market simply break? It starts with a concept called market microstructure. Think of it as the plumbing of the financial system. On a normal day, it's a robust network of pipes. But on this day, the pipes were too narrow. The catalyst was a sudden massive wave of sell orders, likely from a few large institutional players. This initial wave overwhelmed the market makers, the firms whose job it is to always be ready to buy and sell. They widened their spreads, meaning the price to sell got much lower and the price to buy got much higher, or they pulled back altogether. This is what we mean by thin liquidity. The buffer was gone. Then, the machines took over. High-frequency trading algorithms, programmed to detect and react to market movements in milliseconds, saw the downward momentum and amplified it, selling aggressively to get ahead of the fall. At the same time, another force was at play, the Exchange Traded Fund, or ETF. ETFs are baskets of stocks that trade like a single share. When the price of the ETF itself started to plummet, arbitrageurs and the fund managers themselves were forced to sell the underlying stocks in the basket to keep the prices aligned. The ETF, a tool of diversification for many, became a weapon of mass destruction, transmitting the panic across hundreds of individual stocks simultaneously. The system's safety mechanisms, the circuit breakers designed to pause trading during extreme volatility, were triggered. But they proved to be a double-edged sword. While a halt can provide a moment to breathe, it can also trap sellers and build up a massive hidden wall of sell orders. When trading resumed, the market often gapped down even further, as all that pent-up pressure was released at once. The truth landed. When the dust began to settle, a stark reality emerged. This wasn't a fundamental reevaluation of the economy. It was a technical failure, a liquidity crisis, a structural breakdown in the plumbing of the market itself. The value of the companies hadn't really changed by 20% in a few hours, but the price of their stock had. When confidence breaks, money vanishes fast. Because money in the market is, in many ways, just a shared belief system. It's a consensus on value. And when that consensus shatters, the value disappears into thin air, waiting to be re-established at a new, much lower level. So what are the lessons? For investors, the takeaways from this $600 billion classroom are brutal but essential. First, true risk management isn't just about diversifying across different stocks. It's about understanding your exposure to systemic risk. It's knowing that in a true panic, everything can become correlated. Second, position sizing is paramount. An oversized position in even the best company can wipe you out if you're caught in a liquidity crunch and face a margin call. The market can stay irrational longer than you can stay solvent. Third, and perhaps most importantly, is the role of cash. Cash is not just a zero-return asset. It's an option. It's the ultimate hedge. It's the dry powder that allows you to survive the storm, and more importantly, to take advantage of the incredible opportunities that present themselves when everyone else is forced to sell. Having a cash buffer isn't conservative. It's strategic. It's the difference between being a victim of the crash and being a student of it. So what does this all mean for you? It means understanding that the market is not a perfectly efficient, rational machine. It's a complex, dynamic system of systems, driven by human psychology, amplified by technology, and subject to periodic, violent breakdowns. It means your primary job as an investor is not to predict the future, but to prepare for a range of possible futures. It means building a portfolio that is robust, not just optimized for the best-case scenario. Ask yourself, if a day like this happened again tomorrow, what would happen to my portfolio? Would I be forced to sell? Or would I be in a position to calmly assess the situation and act rationally? The framework is simple. Know why you own what you own. Don't use leverage you don't understand. Size your position so that no single event can knock you out of the game. And always hold enough cash to sleep at night and to seize the day when opportunity arises from chaos. Because after the panic, after the headlines, after the forced selling is done, clarity returns. And with clarity comes opportunity. We've just scratched the surface of this event and the powerful forces that shape our financial world. Want to know how this happened in even greater detail? And what specific strategies you can implement to protect yourself and even profit from this volatility? Stay tuned.